It's a great time we meet for this session. My name is CPA Dunochoi. I do sessions on financial reporting and advanced financial reporting, and generally in accounting, like now financial accounting and other practical areas of accounting. So today I would like to emphasize on which areas we expect in the coming exam, that is the exams which will be done in August. So remember that starting from financial reporting and analysis, this is a wide paper, so it's a wide subject at the same time. So when talking about financial reporting and analysis, remember that there are major topics which you need to be conversant with. So starting from group accounting, going to published financial statements, going to financial analysis, whereby you have to understand on how to do the analysis of the various statements of an organization using ratios and using the common size method. Then there is a partnership, most part of partnership being conversion of a partnership to a company. Then we have branch accounting. We have the branch accounting. So those are the major areas you need to be conversant with if you want to pass the exam of financial reporting and analysis. Even if there is these small topics, like now, accounting for the agricultural activities, we have a provision of farms, we have contracts. So those are the ones you can be able to revise on anytime and understand. But now the first topics I've mentioned, before you go to exam, make sure you become conversant. So there's various videos I have done online, that is in my YouTube channel. Some are on the public platform, some are on the private platform. If you could like all the videos on financial reporting and analysis, you can be able to talk with me. I would be able to provide access. So my obvious number, you know it, that is 0728 760 546. So moving to the advanced financial reporting and analysis, for the guys doing the advanced level, remember that now for the students who are on the old structure of the CASNEP syllabus, this is now the last moment you are supposed to make sure that you pass this paper. The first topic, group accounting, that is advanced financial reporting. The next one is all about presentation of cash flow statements. Number 3 is all about the reconstruction, that is reconstruction and the reorganization of the capital structure of an entity. Mostly focus on external reconstruction, but also you need to be conversant with internal reconstruction. Then we have earnings per share, both basic and diluted. Then try to be conversant with the small topics like presentation of the statements of an insurance company. We have the accounting for income taxes. So you know those small topics like employee benefits, segmental reporting. But without mentioning about the small topics and advanced financial reporting, if you want to pass your paper, number 1, group accounting must be a priority. Number 2, cash flow statements must be a priority. Reconstruction must be a priority, with more emphasis on external reconstruction. And finally, you have to talk about earnings per share. At the same time, I provide materials for these videos, online classes. Like now we are doing a block revision. Today, this is 12th July 2022. Today I will be doing questions on reconstruction, that is external reconstruction. For the guys who would like to join that revision sessions, you are welcomed, you can join. Use my number we discuss more about what is required. To talk a bit about a topic which applies in both areas, that is advanced financial reporting and financial reporting. So there's this topic which students find to be a bit wide and a bit challenging. They call it group accounting. So on my previous sessions, I posted a short clip concerning major adjustments which you are supposed to do when doing this group accounting. And some of the students requested that I talk more about those adjustments. So I would like to talk about the major adjustments done in group accounting, so in depth now, for around 20 minutes or so, or more. So remember that when we talk about this aspect of group accounting, it's all about one entity acquiring others. So the others are called the investee companies or the acquiree. So the one which acquires these other companies is called the parent. So the other company is called acquiree companies, which are investee companies. So the investee companies can be subsidiaries, they can be joint ventures or associates. So a subsidiary is a company which is obviously controlled by the parent because the percentage of acquisition is more than 51. So for a joint venture is an entity acquired exactly at 50%. Then for an associate is an entity acquired between the percentage of 20 to 49. So in associates and joint ventures, the parent doesn't have control, but you just have an interest there. Like in associates, we say the interest is called a significant influence, of which there is various indicators of significant influence. And in accounting for these two associates and joint ventures, we always use a method called equity, whereby the associates are measured with initial cost of investment. We adjust with post-acquisition profit or reserve, whereas the impairment loss. So before I go to that route, I would like to talk about adjustment number 1, which is measured in the group accounting concerning on how you are supposed to compute for the goodwill. So goodwill can be done using 2 methods, but in one question you cannot use both. You can either use full or partial. On which scenario can you use full? On which scenario can you use partial? So for you to use the full method in consolidation, obviously the minority shareholders, because now if we say the parent has acquired another company up to 80%, remember that the 20% is what goes to the minority shareholders. We call them the non-controlling interest, the NCI. So when the parent would be computing the goodwill of this subsidiary it acquired, it can use full method or partial. So for the parent to use the full method, the NCI, the minority shareholders, must be stated at their fair value. So you must be given the fair value of the non-controlling interest. So the fair value of the non-controlling interest must be provided. So if you are not given the fair value of the non-controlling interest, you will be given information to aid in the determination of this fair value of the non-controlling interest. So which this information can be provided. So you will be given the market price of the ordinary shares of the subsidiary as acquisition date. So the market price of the ordinary shares of the subsidiary as acquisition date. So you will take the percentage of the minority shareholders, like now if it's 20%, you multiply with the ordinary shares of that subsidiary, you multiply with the market price of those ordinary shares. So that is how you arrive at the fair value of the non-controlling interest. We are not provided. But now if you are not provided with the fair value of the non-controlling interest direct, and at the same time you are not given that market price of the ordinary shares of the subsidiary as acquisition date, so you go for the partial method now. So when using the full method, the goodwill is only attributable to the parent and subsidiary. Sorry for that. So the goodwill is attributable to the parent and the non-controlling interest, the minority shareholders, that is. That is when you use the full method, the goodwill is attributable to the parent and the minority shareholders. But now when you go for the partial, remember that I have said, if the NCI is not measured at its fair value, the non-controlling interest is not measured at its fair value, or you are not given any information in the determination of this fair value of the non-controlling interest, you go and use partial. So meaning that partial, the goodwill is only attributable to the parent. There is nothing attributable to the minority shareholders. There is nothing going to the minority shareholders. Another thing you need to understand is all about what is concerning unrealized profit on stock before I move to the fixed asset. So there's a time you will find that this parent sold some goods to the subsidiary. So now this is adjustment number 2. The first one we have talked about goodwill, how you are supposed to compute about it. Then I will be able to mention later on how you are supposed to present goodwill in the statements. Or I can say that goodwill, obviously, it's an non-current asset. After it has been subjected to an impairment review, or with the impairment itself is an expense. So we move to number 2, the unrealized profit on stock. So let's say the parent sold goods to the subsidiary, or the subsidiary sold goods to the parent. So it can be a two-way, downstream sale or upstream sale. So you will find that the entity which received these goods never resold those goods by the end of the year. He sold maybe a small fraction of the goods. So, but remember the seller, when he was selling, if it's A who sold to B, if it's the parent who sold to the subsidiary, the parent realized the entire profit. But now this subsidiary, at the end of the year, he has sold a fraction of the goods he received from the parent, meaning that this subsidiary has not realized the entire profit with the parent realized. So in this case, we need to compute the unrealized profit on this stock, on the goods which are unsold in the subsidiary, so that we adjust in the parent books. Because the profit of the parent is overstated, so we have to eliminate that. So what we are supposed to do with the unrealized profit on stock due to downstream sale, we debit retained earnings account and we credit the inventory account. But how do you compute this unrealized profit on stock? You obviously take the unsold goods times the profit margin. Unsold goods times the profit margin. And if it was due to an upstream sale, whereby the subsidiary is the one selling to the parent, or with the parent is the one which never resold all of those goods by the end of the year, remember that the profit of the subsidiary would be overstated by what the parent never realized on the goods unsold. So you have to compute for that UPS, then it will be eliminated in the books of the subsidiary by debiting the retained earnings with the share the parent controls them. You debit the non-controlling interest with the percentage of the non-controlling interest, then you credit the inventory account with the total amount of that UPS. So that is adjustment number 2. Adjustment number 3 is concerning unrealized profit on fixed asset. So this is whereby you find that there is a fixed asset which has been sold, like a plant, from parent to the subsidiary. So when a fixed asset is sold, the entity receiving this fixed asset will never resell it. Like now if it's the parent which sold the plant at a profit to the subsidiary, the subsidiary receiving this fixed asset, it will never resell that fixed asset. What does this mean? It means that this subsidiary will never realize the profit the parent realized. And this one means that the profit of the parent is overstated by what the subsidiary never realized. In order to avoid profit overstatement in the parent, we need to compute this unrealized profit on fixed asset due to the asset which was never resold by that subsidiary. Then we are adjusting the parent books. So how do we compute the unrealized profit on fixed asset? We obviously take the value at which the asset was transferred with times profit margin. Transfer value times profit margin. Transfer value times the profit margin. So how do you adjust? How do you adjust the unrealized profit on fixed asset now in the books of the parent? So what you are supposed to do is all about, we need to eliminate that profit which is overstated in the parent books by debiting the retained earnings and crediting the asset account, the PPE. So due to these intergroup sales of a fixed asset, you will be told that when the parent was selling this fixed asset to the subsidiary, he charged depreciation. He charged depreciation. So if the parent charged depreciation, then the subsidiary again receiving this fixed asset, he charged again depreciation on the same asset. So there is a double depreciation they have done on the same asset. We call it depreciation overcharge. How do we determine it? We take the unrealized profit on fixed asset times the profit margin. Sorry for that. We take the unrealized profit on fixed assets times the depreciation rate. Or if you are given the remaining useful life, you take the unrealized profit on fixed assets, you divide with the remaining useful life. You divide with the remaining useful life. Then how do you adjust this depreciation overcharge? Remember that if they did a depreciation overcharge, they understated the value of the asset. So what's supposed to be done is all about, we need to adjust because now an asset has been understated and our profit was understated because there is depreciation which has been overcharged. So we credit the retained earnings account and we debit the asset account. So debit PPE, property, plant and equipment account, credit the retained earnings. Another adjustment you need to understand is all about revaluation gain. The revaluation gain on an asset. So the revaluation is all about the difference between the fair value of an asset, the fair value being the market value, and the carrying amount or the book value of those assets. So the difference between the two, the fair value of the asset and its carrying amount, of which obviously you would find that the fair value is higher than the carrying amount. So the examiner can test you this revaluation in 3 different ways. It will provide the fair value. For example, if it's an equipment, it will provide the fair value of the equipment, for example, being 290, and they will say that the carrying amount is 250. So that one, on that case, the revaluation will be 40. Because now the difference between fair value and the carrying amount. Or you can say the fair value of the equipment was in excess of the carrying amount by the 40. Or the third way you can test you is all about by saying the carrying amount was less than the fair value by 40. So the first scenario I've said, you are given fair value, carrying amount. You take the difference. Or they say the fair value was in excess of the carrying amount by the relevant figure, which is now our evaluation. Or they say the carrying amount is less than the fair value by a certain figure, and that will be our revaluation. How do you adjust this revaluation gain in the books? So remember that once there is revaluation, the value of the asset has increased. So debit PP account, credit the revaluation reserve account. So due to this revaluation, you will find that there is depreciation which has not been charged on the revalued amount. So we need to know which is the depreciation inside this revalued amount. And that is why I can go ahead and say that they did a depreciation undercharge because they never subjected the asset to the entire depreciation which was needed, because now the revalued amount has not been subjected to any depreciation. So we need to know which is the depreciation inside this revalued amount so that we adjust in the asset account and at the same time in the relevant account being retained earnings. So on the case of a depreciation undercharge, we will take the revalued amount, we multiply with the depreciation rate. Or if you are given the remaining useful life, you take your revalued amount, you divide with the remaining useful life. Then you adjust by doing what? Because if there is a depreciation undercharge, it means that our profit was overstated. And at the same time, our asset was overstated. The figure of the asset was more. So to adjust now in the books, remember that this amount would be credited in the PP account. The depreciation undercharge would be credited in the PP account, and at the same time it will be debited in the retained earnings account. So debit retained earnings account, credit the PP, the property, plant and equipment account. So those are the adjustments which can never miss in any exam. Those are some of them I've mentioned. Moving to other adjustments like now, intergroup owings or intergroup balances, cash in transit, goods in transit. So let's talk about intergroup owings or intergroup balances, the outstanding, whereby you find parent owes the subsidiary or subsidiary owes parent some amount. So if the parent owes the subsidiary or the subsidiary owes the parent, and this amount has not been settled by the end of the year, remember this amount which is outstanding by the end of the year is not supposed to be carried forward to the next financial year. Why? Because the parent will consolidate the subsidiary by the end of this year, and they will share some of the percentage to the minority shareholders. So there's no way you can carry forward the amount which was outstanding this year to the next financial year. So it has to be disregarded this year by crediting the receivables account and debiting the payables account. So any outstanding balances between the parent and subsidiary which has not been settled by the end of the year under consideration, it will be disregarded in that financial year by debiting the payables account and crediting the receivables account. Cash in transit is whereby you find that an amount which was outstanding has been paid, but it has not been received by the end of the year by the other entity which was supposed to receive that amount. What are you supposed to do with this cash in transit, which was received on some date after the end of the year? Let's say if our financial year was ending 31st December 2022, the cash was received on 1st January 2023. So we need to adjust the year 2022 with the cash in transit by debiting cash or bank and crediting the debtors. Because this is an amount which has been paid. Yes, it was outstanding. It has been paid, but it was just received some few days after the end of the year. So we have to adjust it in the current year under consideration by debiting the bank account or cash and crediting the receivables account. If it's goods in transit, the same as the scenario for cash, but now you find it's goods which were sent by one entity to the other, parent to the subsidiary. But this subsidiary never received those goods by the end of the year. And when the parent was selling these goods, he sold them at a credit basis. So these goods were received by the other entity some few days after the end of the year. So those goods must be adjusted in the current year under consideration by debiting inventory account and crediting the payables account because they were on credit. Then if there is some errors which you need to make in your statements, you correct where relevant. So most of these adjustments, not even most, all of these adjustments I've talked about, they are adjustments which are made between the parent and the subsidiary. The one which occurred, the transactions which occurred between the parent and subsidiary. So if these transactions occurred with the associates or joint venture, we don't eliminate in consolidation because associates or joint ventures are not group members. They are not group members. You don't eliminate. When you have an associate or a joint venture, remember that in the income statement, we always consider around 3 items. For example, if they paid dividends or interest, we obviously deduct under investment income. If its goodwill was impaired, we have to consider. And the parent must take the share of his profit after they have paid tax. Then in the statement of financial position, we obviously account for the associates or a joint venture using the equity method under the International Accounting Standards 28. So these just are some of the things you need to know. And this last minute, this is what I will be doing in class. If it's a topic of consolidation, I pick a question, I just give out some introduction part, the way I have done, then now I put it relevant. All the adjustments I have explained. Now we check a question which has all of these, the question which has all of these adjustments.